Greetings, this is Dr. Jeffrey Scott, and this is my weekend market update, part two, stocks to watch for October 5th, 2025. Email marketmripro@gmail.com. Google Group Top Down Trader website is marketmripro.com. I do these videos frequently, nightly, for educational purposes only. Any recommendations take the spirit of education, not investment advice. Any observations and market expectations, beliefs, understandings are mine and mine alone. I do the videos to show you how to use my tools. Trading involves risk. You're solely responsible. I may own and intend to buy or sell any stock I mention. Trading stocks and options should be considered risky. You should always consult with your financial advisor before making trades. And I have tools in multiple platforms. My wealth charts video will be done sometime tonight as well, and then we'll try and get it up before the Wealth 365 event starts tomorrow. Obviously, the folks at Become a Better Trader and the other entities related are going to be busy tomorrow with the wonderful event that they hold every quarter. Some of my largest audiences I've ever spoken to have been at those meetings. If you came on Saturday, you weren't a large audience, but you seemed to enjoy what we were doing. I certainly appreciate you being there, so thanks for coming. Um, what we talked a lot about is what drove this. This was a copy of a video posted on YouTube April 7th when Jeffrey Scott, was one of the first to call a bottom in the pullback. More importantly, if you recognize a bottom, you can jump into the emerging leaders and get them before a big run. And the best returns I have ever had in the market were the first 6 to 9 months in 2020 at the end of COVID, and 2009 starting around March 9th, April 9th, March 9th, it's been a while, April 9th, and then what happened starting on April 8th. In fact, if you look at my portfolio, which was only 150,000 at that time, which doubled to 300 by July. If you look at my portfolio since the bottom, it's up $739,000 of gain. I did add some more principal, but the gain was 739, up 441% off the bottom. And guess what? It was still up again last week. I don't know how long it runs, but those numbers seem crazy. They are crazy. They're real. That's my account performance taken from the Schwab website, 10/3/2025, end of day. Um, but these are when you make money, and that's what I talk about at my meeting: how to find bottoms, how to find tops, how to take advantage of them, and how to get outsized returns. My meeting is October 26th to 27th in Palm Beach Gardens, Florida. It's $12.50, including all your meals and a ride on Stocks and Docks, my yacht, on Sunday night for dinner if the weather allows. The hotel's $155 a night, 2 packed days of education. Everybody who pays the $12.50 will get a rebate of $400 towards future purchases, whether they are, well, future means the day after, a minute after you pay the $12.50. Whether you want to buy my app, my tools and other platforms, whatever it is, or you want to use it for next year's meeting. I'll teach you what I've learned from the masters over 30 years, how to master a top-down approach, how to use options to multiply your performance, the how, what, why, when, where of money management, how much to buy, stops, targets, my special sauces of seasonality, relative strength, and more, and then how to master my tools to make it easy. Know your news and earnings. Of course, we have a lot of Fed speakers this week. We got the FOMC minutes coming on Wednesday. I don't expect too much of a surprise. There have been so many Fed speakers talking. I don't think it's going to do anything to disrupt what's likely almost 100% to be a cut coming. On the right-hand side, the big yellow arrows represent government reports, which we're likely to not get, just like we didn't get the monthly employment situation. We will get things, I think, like consumer sentiment. We probably will get the trade deficit and consumer credit, but we may not. But those are things that may not be blocked by the shutdown. On the right, you could see those Delta earnings on Thursday signal the beginning of the next earnings season. Not much this coming week, but as it says in the lower right-hand corner, it's a judgment called old stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. On to the charts, and I don't know if you had a chance to join my meeting on Saturday. I thought it was a great meeting. I hope you all enjoyed it. It is on YouTube under videos of mine. Just search Jeffrey Scott, hit the videos, live market and stock review, market MRI Pro 10/4/2023. It really goes into detail how I made those returns, how I use my tools, and how I potentially can help you. Certainly, there's no guarantee that you'll have returns anywhere like mine. My wife thinks I'm crazy because of how focused I am in my free time on the market, but it's my hobby, it's my passion. I just have a full-time day job, so I've had to do that return while working full time and not sitting at my screens all day. Hey, I think that's a good thing. All right, typically when I go into the program, the first thing I look at is the daily briefing. And just to review, let's just look at the week we came out of. 12% move on Bitcoin. The rest of the market, this in the middle here is volatility, but the Russell, Qs, diamonds, and spiders are up, all less than 2%, but they're all up, all finishing in the lower part of their range. Volatility was up a bit on the week, and the dollar was down. The new highs minus new lows of 52 weeks remain triple digits, which is great, and a lot of it is because the number of new lows has dropped. Participation grew over the weekend. You could see in the soul lines here, 65% of the S&P 1500 were up, 58% of the NASDAQ, and 63% of the NYSE. That, folks, is a good number. It shows breadth improved. What led in the market was healthcare, utilities, financials, a bit of a flip because the laggards were discretionary, tech and communications. And I always like to look at the themes that were leading. This is a percentage change, and you got copper, clean tech, robots, genomics and biotech, exploration, biotech, renewables, metal mining, home building, robots, autonomous vehicles, and so on and so forth. The next thing I look at is my timing model. You can see here the daily, the green line, the green and red line under the charts remains green. That tells you you're long the market. I look at other things to give me how much cash to have. If I were to pull up the weekly, it'll take a while, but I can tell you that the weekly is also in a buy mode. If we look at the US indexes as I did over the weekend, I think I can give you a summary of the the four big ones, the spiders, the Qs, the diamonds, and the Russell. The summary is one, seasonality has turned around, is now positive. Woohoo. The 17-day and 50-day moving averages are both below the stocks, the ETFs, and the markets. That's great because it says when we get a pullback, we've got some nice support underneath. We all hit a intraday high this week, and for the most part, all-time closing highs across the different indices. So for the most part, extremely bullish, not super extended by high jump. But when you look at the run we've had off the bottom, certainly we're going to have pullbacks. And when I see the number of divergences on the indexes, it makes me think that we could get a pullback sooner than later. But with that support underneath, the strength of the market, the fact the Fed is cutting, the fact that the economy appears to be holding up, hard for me to believe we get more than just a 3 to 5% max pullback. Volatility is one of the reasons why I think we could get pullback, and you could see why it is well off the bottom and was actually positive the last 2 days despite the market setting all-time highs. The dollar here looks like it's going sideways. Well, it is. And if you look at a longer period of time, oh, come on now. Let's just do that over 250. If we looked at a longer period of time on the dollar, you would see that the dollar is well off of its highs and just going sideways, consolidating. So to me, not an issue. On the commodities, again, we went deep in this over the weekend. Gold and silver are both trading what gold is all-time high area, silver's multi-year highs. I think they go higher. Why? Dollar's probably going lower if we're cutting rates. And if you look at the oil has dropped, natural gas heading back to the 50. And if there's one thing might be concerning is the 10-year was up 0.71% and the 30-year was up 0.34 or something in that range. So both of them were up a bit this week. Both of them are well off of where they were consolidating. So I think the markets look good. Markets probably go higher. But again, with the caveat that at some point we're going to get a small pullback. The bucket shifted to the right on Thursday. We were starting to build up stocks below the Bollinger Bands. Now they've shifted to the right, and I'm seeing some above the bands. So I put that at a neutral stance. The next thing I look at is my market breadth. On the left is the NYSE, on the right is the NASDAQ. And it's actually a pretty good report. The NYSE set an all-time closing high and all-time high. NASDAQ set that on the day before Thursday, sold off a little bit on Friday, but stocks above the major moving averages higher on both. Up down, excuse me, new high, new lows, advanced decliners, and up down volume were also green. And both have bangos, which is one of those exuberance to the upside signals, showing a lot of buying still happening. And on the other market breadth tool, if we look at that where that green thing is 0.88 on the Spider, on the NASDAQ composite, it's 0.84, on the Russell, it's 0.86, and on the SP 1500, it's 0.89. That is the 13-week new high, new low. We went into it. I showed it in Ward TC 2000, why that is such an important signal. Here it's off the highs. It's not giving us any kind of concern. What is concerning, if you look at the RSI, which is the one on the bottom, light blue, and then a weird color here, in each case, the peak back here in September is higher than the current peak, despite the fact the markets hit higher highs. If you look at the AD line, especially on the NASDAQ composite and the Russell 2000, big time divergence. So that bothers me some. Nothing has to happen because of it, but it suggests to me that it would not be a shocker to see some element of a pullback here from the divergence. Now, why do I spend so much time on the market? Well, go watch the Saturday video and you'll see that I'm a big believer that most of the performance that happens tomorrow is going to be the market. And to be honest with you, as I was sitting at dinner tonight at 5:55, and I normally don't watch the futures that much, especially since I don't have as much in the market as I historically did when I didn't work this hard at my day job. I was really wondering what to expect. Would the futures open up higher? Would the futures crash? Mondays in October are notorious. And they're up a little bit, nothing to write home about, but they certainly, at this point, 10 o'clock or 8:30 rather, evening on the East Coast, they're not crashing, they're up a bit. On the ratio charts, which is one way of looking at relative strength of Bitcoin or the S&P 500 sectors versus the spider, and the winner over a longer period of time is technology. Communications is weakening some, but still strong. Bitcoin strong, and look what happened with healthcare. Big improvement there, and utilities. If we go into the JAS layout, we can start to talk about stocks. And on Thursday, when I did my top-down analysis, to do the top-down analysis, I go into the top-down group. I rank by percentage change. I looked at the top 3 or 4, and I was surprised to see technology down here because if I look over any length of time, it was the second strongest on the FM2. So I went with healthcare, financials, and technology. These are the sectors here that I picked. These are the industry groups, and these are the 1,923 stocks in those sectors. So if I rank by percentage move here, I can pick the top 10. 3. And then I proceeded here to come down and put a $5 and 500,000 filter on it and take that 1087 down a little bit to 497. And then I demonstrated a number of different ways to slice and dice the group to see what's leading. One of the things we talked about was the payers. And although I'm not putting Humana as my stock to buy, maybe it should be. Why? I'll go to the weekly and you could see Humana has had a big fall, as has the entire class. You got a big bottoming tail on Humana on the weekly chart. When we look at the daily chart, you see it breaking out above the 50 and the 200. on pretty massive volume. You see a new CPR signal. You see volume breakout momentum. You see relative strength breaking above its moving average, and you see OBV is strong. I just don't like the loosey-goosey pattern, but my guess is Humana goes much higher. I bought, when they started turning around, I bought CVS, which I like better because it's above the moving averages in an uptrend. And really the one that has, and the reason why I think this group has turned it around is if Warren decides he wants to be in, not UMH, I want UNH. If Warren wants to be in healthcare payers, then people are going to wonder why. And if you look at what we see here, was this is the day Warren announced he was buying after hours, and this is the gap up when people realized that Warren was in payers. That's when I bought CVS. It was amazing to me as I went down this list, uh, how many payers were in here. Here's Elevance. That looks pretty good if it can break above the 200. Here's your United, which we were just looking at, Molina Healthcare. Um, so something is definitely going around with payers. The other thing that I thought was interesting was laboratories. So Thermo Scientific Fisher is probably the big name, and break above the 200 and the 50 on a big move, consolidated move here. Relative strength is spiking. I think Thermo looks interesting. And then if Thermo looks interesting, you might look at Tempest breaking out here to all-time highs. You might look at Rail, spin off from Illumina. You might look at Illumina. So these lab companies are starting to look interesting. Another biotech that I thought looked interesting was Biogen IDEC. This is the granddaddy of the biotechs. If you look at a weekly, you could see, but on a monthly, as its products have gone generic, it's sold off quite a bit. But when you put on a daily chart, you can see relative strength shot up ahead of price, but the price is breaking out. I thought that one looked very interesting. CRL is a clinical trial based company in a lab breaking out of trendline resistance. So there are a lot of things in healthcare. Danaher is another one of these lab supply companies breaking out like Thermo. So that's another wolf pack that I saw were these labs. Something else that I liked a lot was Shopify. And I think Shopify is potentially the one I want to work up as to how I might trade it. Kind of a cup and a handle and a breakout on a volume breakout momentum, just came out of a squeeze. Relative strength looks good. OBV looks good. So I think Shopify looks really good. If I go back to my basic list and just think about other things that I liked, something's going on with home builders. Now, ITB looks like it's ready to run, but I'd rather buy stocks. And so two of the ones that I liked were DH Horton or DR Horton. Kind of like the ETF, pull back to the 50, looks like it wants to go higher. And another one was Pulte Home. I thought this one looks good here as well. Um, on the oil for energy front, I'm not a big fan of energy, but I like MRC here. It's basing its pullback to the 50, coming out of a squeeze with a breakout momentum, and the relative strength is turning up. And then something's going on with cars. All right. Tesla, let's talk about Tesla first. Tesla had a bad day on Friday and a bad day on Thursday. It also has had a big run up here. And if you look at its multiple, here we're showing 223. You look at something like Ford, boring Ford, nice uptrend, gradual uptrend, bit of a breakout on Friday. Look at that relative strength breaking out. Well, Ford pays a dividend of 7.92 and has a multiple of 8. Um, Either Ford's multiple is too high or Tesla might be too high, too low, too high. Ford's multiple is too low. ALV, I believe, is an auto retailer, and you could see ALV is sort of basing. It looks like it's ready to break out. ADNT is a auto parts manufacturer. On the daily looks darn good and looks like it's ready to run. So there are a number of things that look like they're ready to go. I want to just spend a second on the FANG stocks because some of them look bad. Apple, I wouldn't say that Apple looks anything but pretty good to me. It kind of looks like a cup and a handle ready to break out. Amazon is stuck between the 50 and the 200. It just can't get going. Google, big run up, a little bit of a flag. That looks fine. Meta, not so good. Meta has broken below the 50. Seasonality is a little weak here. Doesn't come and visit the 200. Microsoft, a big leader, and now it's just going sideways. And I own some here, hence why all the lines on the chart. It's just doing nothing here. Netflix is going down. Will it stop at the 200? Seasonality starts to pick up soon, but it seems destined to come down and get closer to the 200. Nvidia, not your traditional FANG, but despite all the naysayers thinking its time is over, is just off all-time highs, broke 190 this week for the first time, still looks really, really good. Palantir, like Tesla, had a breakdown day on Friday, and you could see that here. Now, how excited do you get by this? It's got support right underneath. And if you go and you put it on a weekly chart, you can hardly even see the pullback with the run that it's had. So I'd be very careful hanging the crepes and planning the death of Palantir. And speaking of death, I think we already showed you a few minutes ago, Tesla had a bit of a breakdown. Tesla comes back to the 50, it's nothing wrong with it. I think about buying it there, but I doubt we'll fall that much. So overall, I'm a little nervous about this market. I don't think it falls much if it falls. Odds are it just keeps going right away. New highs beget more new highs. Um, Very quickly, if I was to go look at something to buy tomorrow, what I'd be looking at is probably Shopify, which I've been in and out of for a decade. Probably should never have gotten out of it, but then you'd have to ride some pretty big bumps. Those that know me that if I'm going to buy Shopify in my account, I am probably going to look at options. If I was to look at options, I'd pull up my spread maker here. If it, oh, hold on a second. There's so many windows open, it takes a little bit of time. So let's put in Shopify here. Boom. And let's look at November options because October is too close for me. So it'll be the third week in November, which is the 21st, which are the monthlies. I want at least a $10 spread on the options. I am bullish. So strike price of 160. So the things that, let me just now open up the spread identifier, long stock, long call, bull put, synthetic, call ratio back spread, married put somewhere in here. I don't even think that's a bearish thing, and then a butterfly. All right. So these are the potential spreads I would consider. You will see a theme as I go through what each of these spreads might look like. Let me just check one thing and see if updating it is going to, or will it update? I don't think it'll update. So I think I'm going to have to close these down. Give me a second just to clear these. I use this tool mostly for teaching. So I am looking for the magic option. I want to pay the least reasonable to control 100 shares. I would like maximal upside, and I don't want to lose much money. So let's look at what the stock would do to me. So if I bought the stock, as you could see, it's got a pattern which basically says, if I bought the stock at the money, if the price goes up, then the value of the option goes up with it. The price goes down, the value of the option goes down with it. This is the price P&L curve on a share of stock. Very simple. To control 100 shares, it's going to cost me $16,100 $114. So 100 equals 16K. My upside is infinite, and I could lose 16K. Now, no one's going to hold it down to zero. We're all going to have money management. And if we went back into the stock, let's go back and look at Shopify. If I was to buy it tomorrow, and this, by the way, again, is for educational purposes only. It is not for what you're supposed to be out and going. It's for you to understand my thought process. All right, why does it want to give me Shopify? Let's go back to here. There it is. So the low on this candle here is 140.91. If I was to buy this, okay, I'm not saying I would, I'd want to take out that high. So the high on that candle is 162.60. So I'm going to buy it at 162.70. 8% of that is about $13, which would get me down to 139. No, 149. I like to look at the low of the last four bars, 1, 2, 3, 4, and the low of that bar is 140.91. So that would put me at 140.85. That's about $18. That's too much. That's 11%. So I got to find another thing. So turns out that yellow dashed line is a chandelier stop. It's at 151.64. So I would put a stop at 150. 150 or 149.95, but that's 1270, 1275 on a stock that's $162. It's less than 8%. That's all I want to do. So I'd probably put my stop somewhere down there. Now, I would put a target on this. I'm bullish here. We're out of August, out of September rather, at 2 times what I'm risking. So probably somewhere I'm risking 12, so 24, 186. So somewhere up there is going to be my target. And so I'm going to want to enter a trade in Shopify. If it takes out that line, I will immediately put on a stop at that line, risking about $12 a share, which is a little bit less than 8%. I am going to set at $24 above this number, so at 170, at 187, which is my target. And what I'm going to do with that target is the way that I trade is I would take off a portion of my trade right there, put profits in the bank, and then move my stop all the way up to where I bought it. And I don't think this 157 means anything here except it's when it broke out above that high. Okay, so I got those numbers. Let's go back here. So I could still put my stops on, but I'd have to spend 16,000 to control 100 shares, and then I'd manage it as I just told you. Nothing at all wrong with that, especially if you're sitting with cash in your account. The benefit of buying the stock versus an option is a stock doesn't really expire unless it's something that is designed weird, a warrant, or something that a preferred thing that they might have the option to buy back. Now, the simple thing is to look at a call. I'd have to buy one call to control 100 shares, and a call is going to cost me 1/10 of what buying the stock was going to cost me. The call is going to cost me 16.20. Now, for 16.20, I can control 100 shares. I get the same as the stock goes up, I make money, but I have to move the amount of the price of the call to break even. So the first $1,620 of movement, or you could see here $16.20 or $15, whatever that is, 16.20. It has to move that far before it breaks even. Now, the reason why this is a great trade is the most I can lose is the premium. So unlike this trade of the stock with unlimited loss, I have capped my loss at the price of the call. There is nothing wrong with taking the call. Question is, can I find something that looks like a call for less money? If what I'm losing is the risk, then I want to spend less money to buy it. Let's look at a call spread, bull call spread. We're going to look at it and we're going to dump it. The good news is on a bull call spread, buying a 160 call and selling a 170 call, that limits my upside to $10 minus the price of the call, which is 4.25. So all I can make is $575 on 100 shares, but it's costing me 425. So you could see here, I cap my max gain very quickly. I cap my max loss. Why would I take this trade? Got a really high chance of finishing in the money, and it's a cheap trade, and you can get rich just taking a little bit of money out at a time. I don't like this trade because I went into this saying I want infinite upside and I want to limit my downside. I've limited my upside, so we're going to kill that one. How about a bull put spread? It looks just like that. Here I'm buying, I am selling a put at the money at 150, collecting, I was selling a put at 160 rather, collecting $13. And as long as the stock goes up, I get to keep that. But the problem is if the stock goes down, I could lose a lot of money. So I'm buying a 150 put for 848. So it protects my downside. So now I'm collecting $4.57. So the most I can make is that 457. The most I can lose is that $10 wide minus the 457, or about $5.43. One of the advantages of this trade, considering that this is the current price, is I can lose up to $4.57, which I collected on the trade, before I start to lose any money on the trade. So good news is downside's limited. Bad news is so is upside. Good news is I don't have to move positively to win. In fact, I can absorb a little bit of a loss. I don't like this trade because I'm looking for building my account. Now we get into a butterfly. This butterfly sucks. You don't want this butterfly. And this butterfly, you're buying a deep in the money call that's 150 for 20 bucks. You are selling two at the call, once at the money calls for 160, which are $15. So you're generating a a a a a credit for 30 bucks against a $20 debit. So you made 10 bucks, but now you've got an unlimited upside that you're short. So you're going to buy a protective call at 170 for 10 bucks. Net net, you pay $1 for this trade. So you're going to control 100 shares of Shopify for $1 a share. How can you lose? Well, you really can't lose much. The maximum you can lose is the $107 that you're paying to control 100 shares. What's the likelihood of winning? If the stock trades above 150 and below 170, you will make some money. Well, you'll collect, yes, you will make some money, but you hardly make any money unless you hit it correctly. So imagine putting on a parachute for the first time, being up at 30,000 feet. The guy next to you hands you binoculars and says, "See that little X?" I go, "Yeah." I'll give you $1 billion if you can land on it and still be alive, and he pushes you out the plane. What's the likelihood you're going to land on the X? 0. What's the likelihood you're going to nail the perfect spot on the butterfly? 0. This is a bad trade. This is a good trade to sell. The bad news is you're risking 10 bucks, all right, minus the buck that you get, so you're risking 9 bucks. But the likelihood of finishing in the money on this is so small. Nobody wants this trade, but they want to sell it. Here's how I can fix it. Let's leave the buy at 150, and let's edit the spread. And let's take the long protective call and move it to 180. Now let's take the 2 short ones, move them to 170. So now what we've constructed looks very different. Now, instead of having a fine point and coming right back down, if the stock goes in the direction you expect, you actually make money no matter how high it goes. It's capped, of course, here, but you're going to pay to control 100 shares instead of spending $1,620, which you would on the call. You're spending $638 to control 100. The maximum you could lose here is the $638. The good news is it has to move $6.38 lower for you to lose any money. So here you have a trade that can go down and you still make money. It can go up a lot and you still make money. And if you're 1 in a million, you hit the needle in the haystack, you can make a lot of money. I love this trade. It gets me in cheaper than a call. I am risking less than a call. I am not capping the range where I make profits. And I could design these so that I get about a 3-to-1 return on my investment, meaning if I'm going to have a $20 potential gain, then it's going to cost me $6 or $7. And I'll pick stocks that makes sense. Limited my downside. Now, what's wrong with this trade? I don't have unlimited upside. That's true. I will often open trades with this if the option prices are expensive. Why? Because I'm buying 2 and I'm selling 2, which neutralizes a lot of the Greek's impact on premium. This is called a broken wing butterfly. It is, if you come to my live meeting, one of my go-to trades, especially around earnings time, because I can buy one to the long side, one to the short side, and they are cheap. And all I need is it to go take to work for one of the sides, and I can make some decent money. So I actually like these trades, and you'll see a bunch of them in my account at least to start. Now the perfect trade is I'll go long something with one of these, and it'll end up somewhere over here. And now I'll have calls that are 10, 15, $20 in the money, and to roll them forward costs me nothing. So now I play the call by itself, unlimited upside, or I might sell a call way out of the money against that call, sort of creating a covered call. But what happens is I set it far away that I never have to get it called away. So I've run a lot of my wins up by getting into the stock with this trade, and then switching to just running the calls up deep in the money, which have little time value of the premium. All right. And now I get you to my favorite 3. Let's look at a call ratio back spread. This is an interesting trade. In a call ratio back spread, I am selling one at the money. I am buying 2 out of the money. I am paying for the 2 out of the money calls, by selling one in the money. So I am buying for $6.70, a similar price as the butterfly. I am buying a long call. Now, if the stock goes to 300, 200, 180, that 160, 170 is a debit spread. It's a credit spread rather. I'm collecting on that $5. If it runs up to 170, I'm out 10 bucks. If it goes to 180, I am out 10 bucks, but the 170 call is now worth 10 bucks and I break even. If it goes above 180, I now have a infinite upside. Because what happens as it goes above 170, the short 160, the long 170 become gone at a minus $5 because I got $5 for selling it, 10 bucks I had to buy it back from. So I end up losing 5. But at a much lower price, I am now in to a single call at a price of $5 or so, 670 here, and I run it up all the way. Now, there's some other really beautiful things. If I bought a call here for $16 or for $6.70, whatever it was, and the stock market crashes, how much do I lose? The max I can lose if it goes down is what I paid for the call. The maximum loss is if it runs all the way to 170 and stops, because then I'm minus 10 on the debit spread, or the credit spread rather, and the debit call is worthless because it doesn't go above 170. And that's why I have the potential maximum down right here. But if I can get to 2 times the delta up to 180, I essentially have a free call and I can ride it as long as I want. So the advantage of this trade is if the market goes kaput, I lose only the premium I paid, which was a lot less money than buying the call. If the market goes to the moon, I've got a naked call minus the $10, which I owe somebody for the short call, long call spread, which I got paid $6 or I got paid about $6 for. So it's a minus $4 or $5. And as long as we trade above that 185 is when I broke even. The maximum loss is at 170. Somewhere between 180 and 185, depending on how much I paid for this, is where the profits start to run. I like this trade a lot, especially because of my protection if the market blows up. If you do this trade, you've got to do things that are going to move. Because if something just stays where it's at and the day after it expires, it decides to move, you don't get any money. But not a bad trade. Do you notice a pattern arriving here? Each of my trades that I like, the long call, the broken wing butterfly, and the call ratio back spread, all have a fixed loss. They're all cheaper than buying the stock. They're all cheaper than buying the call. Now, when I'm worried about the market, and I made a comment about my buy do that I bought stock. Well, actually what I bought was a married put. And a married put means I bought a put at or around the strike at around the price of the stock. In case it was to drop, I was protected. So here I'd buy 100 shares of Shopify for $161. So I got to still pay that 16,000. But for $13, I'm buying a put, which is guaranteeing to me that the lowest I can sell it back for is the price, about the price I bought it at 160. Now, for this trade to turn profitable, I've got to move that $13 or else I lose money. Okay. But once I get beyond that $13, I have stock that has unlimited upside. And until that put expires, I have fixed my risk to the price of the put. Now you can roll those puts up behind. They get to be expensive. So when do I take this trade? When I'm worried about the market, but I really want to be in stock. When I've had 4 or 5 bad trades in a row and I don't want to lose much money. When I have a stock that pays a nice dividend and the protective puts, the long put is cheap. So I've got that going with the utility FE. I bought like 5,000 shares with a January put at the strike price of what I bought it at. The stock's moved up. I get to collect 2 dividends before that expiration. And I know that even if the market implodes, I am capping my losses. So this is a married put. I've become fond of this of late, much more than I used to think I was. And part of it is I don't want to risk the big upside move that I've seen this year in the market. So I've taken a few of these of late. So I wouldn't be adverse to that, except it's kind of an expensive put, $13. It's almost 10%. And it's only helping me for 6 months. So then I'm left with one of my other favorites was called the synthetic. So if I show you this and I was to pimp you and ask you, what does that look like? And you're going to say, oh, Jeff, that looks exactly like buying the stock. And I will say, exactly. If I buy a call and sell a put at the same strike price, I get a curve that's identical to the stop. And the premium offsets the two. The time value offsets. And I end up being able to control on a synthetic 100 shares for $200. Wow. My maximum risk is everything. My maximum gain is infinity. But for $2 or $200 to control 100 shares versus 16,000 to control 100 shares, why would I ever want to buy stock? Here's why you want to buy stock. I don't get the dividends if the stock pays dividends as long as I'm in the options. I have to have a duration here. I might have a 2-month duration and the next 2 months this drops 5%. I end up losing money on the trade. And then the next day, Shopify gets bought by Amazon and goes up to 600. Too bad, so sad. Try again. So I have a duration issue, and I don't get the dividends. Another thing to think about is if you were willing to risk on this trade $2,000 and you can get 100 shares for 200, that means you could buy 10 times this. For $2,000, you can buy 1,000 shares worth instead of paying $162,000. And if I have a lot of money, so maybe I want to buy 500 spreads. And I did that once. And I made a lot of money on an Amazon trade. But I'll never do it again because I look back, I was an idiot. Because if Amazon gapped down, I would have lost a ton of money. In fact, I don't like this trade anymore. I love it because it's cheap. I love it because it looks like the stock at a low price. But now what I'm going to do is I'm going to edit the spread and I'm going to do another option. I want to buy, same time frame, make it a 150. Put, hit OK. There you go. Now, this trade is going to be 1,062. So for 1,062, I have created a synthetic call. It controls 100 shares. It's still going to have to move $10.63 to break even. And now I'm going to decide, since I love this spread, do I want that spread or one of these others? Let's look at the call, which is probably the one that I'd compare it against. And oh, I didn't want to do that, did I? It's all right. Just clear these things off. All right, make a call. But I love this time of year. We got college football, we got NFL, we've got hockey and basketball getting ready to start. Hockey season's this week. This is couch potato paradise, and I am a major sports addict. All right, here is the call on the left. Here is a synthetic call on the right. That's what it is. I have to move all the way to 175 to turn profitable. I have to move to 171. So it's a little cheaper to buy 1062 versus 1520 over here on the call. So I start turning up so it doesn't have to move as much. I like that. My downside risk though is going to be the $500 delta between the two is going to be offset by I'm at risk for $10. So my maximum loss is $2,000 on 100,000 on 100 shares. Is that right? Yep. And my maximum loss here is 1,500. So that includes the cost of the spread and the maximum loss of $10. So I personally would rather get in cheaper at $1,000 versus $1,500 and risk that extra $10 here. I love this compared to the synthetic, the basic synthetic that has the unlimited downside. I don't want that. So I would look at each of these spreads and I would pick the one that makes sense. My guess is I'll be buying a synthetic call on Chop tomorrow. I like the time of the year. I think the risk to the downside is going to be minimal. And that's how I do my analysis. Now, I don't make those curves anymore. I know those curves, but I might build this graph or this chart, and I might come in here and say, I want maximum upside, maximum profits are infinity, and I want the lowest risk at infinity. Here's 1670 on the call ratio, 2765 on a call ratio, 1520 on the long call, 1614 on the long stock, 1419 on the married put, just like buying a long call. And the synthetic long, it's 16,215 because of the $10,000 if or the $1,000. It's because I've got the $10 to the downside. And then it becomes just as much risk as buying the stock. I like the one I showed you, which basically takes that synthetic stock, adds the protection underneath, gives me infinite, and makes it look just a little bit more expensive than buying the call. And I have less room to move to turn profitable. Hope that helps you at how I think about taking the trade, setting my buy stop, setting my sell stop before I make the trade, looking at where a target is, and I will manage the options no different than managing the stock. If I get stopped out, I'm out. All right. If I hit my target, I'm going to sell some and put it in the bank and raise my stop. This is not investment advice. I can tell you how much chemotherapy and what chemotherapy you need because I'm a cancer doctor, but I'm not telling you how to spend your money and what to invest. I'm a financial advisor, but I'm trying to demonstrate for you how I think and how I've been successful taking trades. Have an awesome week. And no one says we have to go down. We're getting overdue, but the futures are holding. And gold's up again as well. Wahoo. Take care, everybody, and thank you.